It's a great question.
Thank you so much. It was a lot of fun.
It's always a pleasure to talk to you.
Thank you for joining Top Investors Talk.
Thank you, Mark, for joining Top Investors Talk. We all know that we experienced the roller coaster in the first half of this year on the stock market. First of all, how do you understand the extreme volatility of this market?
Well, of course, the market sold off when countries around the world chose to shut down their economies in a unprecedented move, and that kind of uncertainty is something the markets don't like. But I think that for us, a key component of understanding what was going on is getting our minds around the fiscal and monetary stimulus that various governments would provide. And I think that remains an important framework as we move into the second half of the year. Perhaps now even more so than what is going on with things like virus counts or international geopolitics.
You're right. The support from the government and the central bank is the key drive of the market now and maybe in the second half of this year. But the question is, do you think how far the central banks will go and the liquidity support will not be indefinite?
Well, it is true that indefinite is a very long time. For example, the Federal Reserve rolled out all the tools that it used in the great financial crisis. It did that in about 2 days. And that was a key sign for us that they intended to be a lender of last resort here. For a variety of reasons, the Fed has been able to say that they're not even thinking about raising rates. And I think this is an important thing that people need to understand. They're being very explicit about their desire to use monetary policy to help support Main Street. But if they're going to support Main Street, that means they're also going to be supporting Wall Street.
You're right. Because of the support of the central banks, the Fed, we see the discrepancy between the Main Street and the Wall Street. So some people worry about this discrepancy.
I think, I have to say first, it's not my job to figure out how the world should work. The tools that a central bank has to impact, how many bars are open in New York City, for example, that's a very weak transmission mechanism. And yet they're committed to providing the liquidity that can help facilitate those things. And therefore, to provide support to Main Street, the Fed, given relatively inefficient transmission mechanisms, the Fed does have to provide a lot of liquidity that does start to flow through to things like stock. But at the same time, if Wall Street isn't doing well, it's going to be very hard for there to be jobs on Main Street. And so that is a little bit the bargain that they're making here. And I think what we're saying to investors is, look, you have to realize that's the case. You have to separate a little bit some of the inequality that may be created by this situation from what can actually happen in the markets.
If the market is dominated by the central banks, should investors stop worrying about things like PE ratio, the traditional asset valuation applied in the market effectively run by central banks?
Well, it is a great question. I think valuations are always important, but you have to adapt your thinking a little bit, because if the Federal Reserve wants to push the equity risk premium in a certain way, they can do that. And if you're not getting any yield on your bonds, then P's do go up. And so I think that the valuations can be higher than normal given the extended Federal Reserve support, the extended central bank support. And additionally, it's hard to look at PEs right now in the sense that we really don't have such a great view on earnings in the near term.
Yeah, so you also mentioned that in the future we'll be in a world with low interest rate and high debt for a very, very long time. What does that mean to investors' strategy? I mean, where to park the money?
Right. Well, look, I think this is a key point. One of the things that we see is that the very low interest rates are forcing large asset allocators like pension funds towards riskier assets, towards equities, for example. Also, there is the potential for inflation in the future as we run up larger debts, and potentially that does impact currencies like the US dollar. But I think we would caution a little bit that it's unlikely for inflation to get too accelerated. Even if you have moderate inflation, it does, fortunately or unfortunately, have a solution, and that is for more investors to allocate towards equities, which can do fairly well even in a moderate inflationary scenario. So I think that's one of the longer term trends that investors are going to have to look at.
I know UBS has also issued the strategy of your second half. The question is, do you think the market will retest the March low at the second half?
We think there's a very low chance of that. What we've learned a lot about the virus, and I think, unfortunately or unfortunately, the United States and Europe have learned that lockdowns don't necessarily work. And so I don't think we're going to go back to lockdowns. Given the central bank support, the low inflation, and the fact that we are to some degree on the mend, I don't think we're going to see a retest of the lows.
In the first half, we see some winners and losers in this market. The winners are tech stocks, stay-at-home stocks. The losers are financial stocks or maybe energy stocks. So do you think in the second half, the winners will continue, or maybe the losers will have some chances?
It's a great question. I think it's a mix. So one of the things that I would highlight that we saw was a particular winner in the first half was strategies tilted towards sustainability and environmental concerns. And our sustainable strategies did very well. And I would expect that to continue. So I think there is some upside for recovery that is slightly better than many anticipate. And in that case, I think we could see something of a leadership change, away from kind of the tech and the stay-at-home stocks, and towards a little bit more value names or cyclical names. So for example, we could see perhaps the UK equity market doing better, which is a little more value focused and a little more cyclical, or Germany doing better, for example, or a switch to mid-cap stocks in the United States, which may have not done as well as some of these large cap and the tech in the first half of the year.
So what the investors should do in the second half? Should they sell, or to the investors sitting on the sidelines, is it too late for them to enter the market?
Well, we don't think it's too late to enter the market. I think where we would shift global portfolios is maybe less NASDAQ heavy and more towards diversified global equities. We've recently seen emerging market stocks do well. The Chinese market has done very well. I think in China we would continue to focus on 5G build out, tech, and then maybe a kind of in the near term, since we've seen North Asia, since we've seen China come back online so quickly, we've allocated some money towards the Singaporean market because we think that in the near term, as they start to recover, they could get a little bit of a bump as well. So I think shifting some of your focus makes some sense, but some of these longer term themes like the tech economy, digital economy, like sustainability, are still going to power portfolios ahead in the second half.
So in the second half, what kind of risks do you think the investors should especially pay attention to?
What investors should focus on in the second half of the year, first is what is the story with the stimulus? Second, how are these virus counts moving in places that it's flaring up, like the United States? And then third, what's going on with the U.S. presidential election, and which side is winning? And for us, with the presidential election, I think that certain stocks can do better or worse depending on how the election ultimately plays out. But in the near term, what's important to remember is both sides, the Democrats and the Republicans, they want to get more votes by providing more stimulus to consumers who are relatively beleaguered here. So we would expect another stimulus package this month, and maybe that can provide some more support to markets.
So final question, Mark, how do you see the investment opportunity in China?
Well, the Chinese market has been doing very well, in part because the recovery has been so successful in China. As you know, the service sector PMI is doing extremely well. It's not just manufacturing. And so I think for us, we're looking at the A-share market. It's less susceptible to some of the geopolitical concerns that could rise up. I think we would be focused on the tech aspect, the 5G build out, where we have allocations to the Chinese market. And then in the bond space, I think the Chinese property bonds in the high yield space are something that we're looking at. I mean, China is on the path to recovery. There is support there. So I think we're going to see a lot of growth out of China in the near term. In a global portfolio, as I mentioned, we may have moved some of our allocation from China to try and pick up a speedier recovery in South Asia now, but that's only because in the near term, China's already done so well.
So thank you very much. Thank you, Mark, for your time.
All right, thank you so much. It was a lot of fun.